Hi everyone, let's go over my bullish and bearish Elliott wave scenarios on Bitcoin, starting with the first bullish scenario where we're looking for a double 1-2. Wave 1 and 2 in blue are finished, looking for this 1-2 to finish and then continuation to the upside in a very big impulsive wave 3, which normally is the most impulsive, highest volume, most extended wave in an impulsive structure. Now, the most common target for your wave 2 is the 0.5 to the 786 Fibonacci taken from the low to the high of your wave 1, sitting between 58.6k and 56.3k, which as you can see has not yet been hit, but the 382 is touched. It is an uncommon target for a wave 2, but it is a target nonetheless. Something to note as well, which is very interesting, is that this blue wave 2 here did not touch the 382. It just missed out both on the linear chart as well as on the logarithmic chart. And that is something that is actually very rare for a wave 2. Now, by all means, when we look at this wave 2 in white, we call it a lower degree wave 2. So the higher degree count is the blue count, 1, 2, 3, 4, 5. And inside the blue wave 3, we have the lower degree white count, 1, 2, 3, 4, 5. Now, preferably, a lower degree Elliott wave count is a little bit shorter in time and price compared to the higher degree count. It is not a must, it is not a rule, but it is more like a sort of guideline because you would expect a lower degree Elliott wave count to generally be a little bit smaller. So when we look at this wave 1 over here, it is shorter in time compared to your blue wave 1, and it is the same amount of price covered in both of the wave 1s. If you take a trend-based fib from the low to the high of blue 1 to the low of your blue 2, then you can see that the 1-to-1 is hit. So both of these wave 1s are pretty much the same amount of length in price. But when we look at the wave 2s, then you can see here we made this low before the 1-to-1 fib time. And the fib time is taken from the start to the end of 2 to the end of wave 1, comparing blue wave 2 with white wave 2. Now, as mentioned, preferably your lower degree white wave 2 is a little bit shorter or around the same amount of time as your blue wave 2. So if this white wave 2 would finish at this low and we're working on an impulsive structure to the upside, perfectly fine. But if we continue ranging sideways here this Sunday, the probabilities do slowly go down for a wave 2 if you take this low over here, because the moment you take out this low, it pretty much confirms that this here was not the end of a corrective structure and you're looking for a bigger 3-wave move to the downside. So the moment price is taking out this low on pretty much a 59.6k, the probabilities for a double 1-2 are, interestingly enough, decreasing based on time. Yes, the most common price target for a wave 2 is below us, right, and below this low over here, but time-wise, it wouldn't be ideal for price to move back all the way to the downside somewhere today or on Monday, because this lower degree wave 2 is going to be enormous in time compared to your higher degree wave 2, and in the end, we trade probabilities. Now, because of the length of this sideways range on the chart and the fact that it is weekend, because it is very rare in the weekend to lift off in a very big wave 3, right? So if this is the low over here of your wave 2, preferably you're looking for another wave 1, wave 2, so a triple 1-2, and then move to the upside, right? You don't want to take out this low, and then the move to the upside should happen at the beginning of the week, Monday, Tuesday, preferably, right? But if we do continue this range sideways, potentially looking for this low, then the alternative bullish scenario is going to be a simple impulse to the upside, right? 1, 2, 3, sideways 4, and then a wave 5 to the upside, where the result is arguably pretty much the same. You're looking for this high to be taken, but instead of a very big wave 3, you take out the high and then you eventually move back to the downside. The common target for your wave 4 is between the 0.236 and the 0.5. Now, because the 0.382 has already been touched over here, I removed the 0.236 from my chart, leaving the 382 and the 0.5, 59.6 to 58.6k, with the invalidation being 57.6k for this particular scenario. Now, on the lower time frames here, we have some complex structures going on. There's the potential for WXYs over here and whatnot. The fact that price made a low here before the 1-to-1 fib time does not mean that the wave 4 is finished at this particular low. That's pretty much what I'm meaning to say. because most commonly a wave 4 is a little bit longer in time than your wave 2. So for a wave 4, it's actually preferred to end after the 1-to-1 fib time taken from the start to the end of 2 to the end of your wave 3 in this particular case. So in other words, if we continue ranging sideways in corrective structures and also even take out this low, we have to continue to keep in mind this particular scenario. And inside this target area, we do have this support resistance flip area, the white box, right? Move towards the upside, have tested it once now in confluence with this range over here, acting as some structural support. And now we have this slow move towards the upside. We have some resistance just above us here, 61.5K to 61.7K. Above this, by the way, an important daily naked point of control as resistance, 63.1K. And to the downside, we do have here a blue box, 57K to 57.9K, which of course is in confluence with the invalidation of this scenario. So that is of course also something we want to keep in mind. But the result of course is the same. You're looking for this high to be taken. Now, what impacts the probabilities for this scenario at least a little bit is that your wave 3 is relatively short compared to what you actually want to see. So if you take a trend-based fib extension from the low to the high of 1 to the low of 2, then you can see that your wave 3 hit the 1-to-1 trend-based fib extension, meaning your wave 1 and your wave 3 are pretty much the same length. However, in an impulse 1, 2, 3, 4, 5, it is by far most common for a wave 3 to extend, meaning to at least move to the 1.618, which is a lot higher, right? We didn't hit the 1.618 trend-based fib extension. We stopped at the 62.6K 1-to-1 trend-based fib extension. Now, it is not an invalidation for this scenario. There's only 3 rules in an impulse, and one of them is that a wave 3 is not allowed to be the shortest wave. It is not the shortest wave because we wicked above the 1-to-1, so we can check that box. The other 2 are wave 4 is not allowed to overlap with wave 1, and wave 2 is not allowed to move below the low, in this case, of your wave 1. So at the moment, all of the rules are respected, and we have to at least consider this scenario because of the bigger sideways range that we have here on the chart. Finally then, the more bearish scenario. But interestingly, in the bearish scenario, we preferably still look for price to actually move to the upside first. And that is because of the explanation that I gave yesterday. Yesterday was a longer video, about 15 minutes, where for most of the video I was talking about this particular scenario here in confluence with the daily bearish scenario, and I want to shortly repeat it in case you haven't seen it. So in the bearish scenario on the daily, which at the moment has a bit lower probabilities, we're looking for a WXY, right? And in Y, we then have a zigzag A, B, and a wave C towards the downside to still make a new low. Now, the reason the probabilities are lower is because the common target area for wave Y is already hit, the yellow box over here. The orange line, the 1.618, is a uncommon / rare target for a wave Y, right? We barely ever move towards the 1.618 for a wave Y. But if you're looking for a flat corrective structure X and then a zigzag in Y with an A, B, C, your wave C target is the white line. And you can see that if price, where price is now in this case, right? If price would top here where we are now, right? This is your high. Look at the 1-to-1 for wave C, 41.7K. That's far below the already uncommon / rare target for your wave Y, the 1.618, right? So it doesn't really make sense. There's not a nice Elliott wave confluence between the two. So preferably your wave B is going to move to the upside closer towards 65, 66, 67, 68K, just to make sure that the common target for your wave C is going to be in confluence with the 1.618. Right? So this is something to at least keep in mind, which means that for wave B, right, on the daily, we preferably look for price to move towards the upside. And this is what happens in this 1 hour bearish scenario, because the scenario is bearish even though we move up. But what we're looking for here is a finished A, B, C. Common target for wave C is the 1-to-1 trend-based fib extension, right? Taken from the low, high of A, low of wave B. We label this as a wave W. Then we're looking for a wave X and a wave Y towards the upside. Now in a double zigzag, which is what I'm looking for here, WXY, where X can be any corrective structure, triangle, flat, zigzag, doesn't matter, WXY. But then after wave X, we look for another 5, 3, 5 to the upside. So a similar structure compared to what we have over here. Most common target for Y are these blue fibs, the 1 to the 1.236 taken from the low to the high of W to wherever your wave X is going to be. But the invalidation of the daily zigzag down in an ABC is this high. And that is very, very interesting because you can see that if price would retrace all the way down to the 0.7, which significantly, by the way, reduces probabilities for a double zigzag, right? 53.1, 53.2K. The common target for your wave Y is the 1 to the 1.236, with the 1.236 being above the invalidation, right? Now, of course, the 1-to-1 is still common, so let's see. If price would retrace to 55K, right, then the common target, right, being the 1-to-1 to the 1.236 is incredibly close to invalidation. So it doesn't even really make sense anymore. And on a daily time frame, the 886 target for wave B, which is okay as a target, but look how far the 1-to-1 is above the 886. That's not really what you want to see. If you move up here, it's very likely you hit invalidation. So preferably your 1-to-1 is in confluence with, around that 886 as a target, which then leaves us to a retracement for X of 53.9K. Now that means we need to look for a deeper retracement on the 1 hour time frame. At the moment we have a very sideways and slow corrective structure, but at least it's something to keep in mind. Now I already mentioned this blue support box over here, 57K to pretty much 58K, and below this we then have 55.2 to 54.6K. But you can also see that 53.9K here is a little bit in the middle of nowhere, and the 0.7 is very close, which really reduces probabilities for this scenario. But by all means, the confluence of these different scenarios is basically that sooner or later, preferably, we're looking for this high here to be taken. Now, when we look at the CVD divergences locally on a 15-minute time frame, then you can see that price has been grinding to the upside here with consistent bullish CVD divergences, which is exactly what we like to see when we hit support, right? The white box plus the previous range here, moving up higher highs, higher lows, consistent bullish CVDs, absorption of market shorts with bigger limit long positions, pushing price towards the upside. You are correct by saying that we also have a bearish CVD divergence on the chart, a lower high on price, but a much higher high here on yellow. However, based on statistics, the first CVD divergence is most trustworthy, and this high over here had its first bearish CVD divergence with the highs here. Lower high on price, higher high here on the CVD. There were a couple of bearish CVDs here with this high. So the bearish CVD you see on the chart right now is like a third or fourth bearish CVD divergence. And only this bearish CVD divergence is actually not really interesting compared to the bullish ones that you have, which are also more local, right? The more local CVD divergences also get priority, plus these bullish CVD divergences are the first divergence with these particular lows, right? So these are at the moment more interesting, where the latest bullish CVD, as you can see, already played out. The only way this bearish CVD can gain in probability is if we change the market structure and also create some more local bearish CVD divergences. Then you're going to have confluence between the bigger bearish CVD and a more local bearish CVD divergence, preferably on a 15 or 3-minute time frame maximum, right? And then you're going to be looking for price to, yes, potentially take out this low and move to the support areas lower. It would be nice with the bullish CVDs that we have, however, very, very locally, for price to take out this high, which then plays out the bullish CVDs we have over here. You can still see a question mark. That is because the target is actually this high over here, which we haven't yet taken. We got close, but we haven't taken it. And also for price to hit the resistance, right? The blue box here would be nice, 61.5, 61.7, and the daily naked point of control above. In case we pass this resistance, that would be my next area of interest, 63.1K. And it is very common for price to range during the weekend. As mentioned, it is rare for price to escape into a bigger wave 3. So the probabilities during the weekend generally are higher to look for ranging structures, right? So this is therefore something that I keep an eye on. If you then finally look at the probabilities of the different scenarios, then currently on the 1 hour time frame, the probabilities are higher to take out this high at some point. And on the 15-minute time frame, the probabilities at the moment are higher to move into that blue box, preferably supported by the bullish CVD divergences. Taking out this high would be nice as well. And then we have to observe the reaction over here. If we can pass this area, next area of interest really for me would be 63.1k. Now, as mentioned, it is most common for the weekend to continue sideways in the range, so probabilities are highest to continue moving up into the blue box at the moment, right? Take potentially this high or at least this high here and then move down again, which depends on the reaction that we see here. We want to see weakness, maybe some bearish CVDs to support the bigger bearish CVD as well, right? Or take the high and then move down, potential swing failure type of move. Take the high, close candle below, move to the downside of the range, because a range is most common in the weekend. So that is something that I'm going to be keeping an eye on. That being said, I hope that this video was helpful or valuable to you. Please check out the brand new complete Elliott Waves guide playlist I've made that shows you all you need to know about Elliott Waves. Thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.